Thanks for tuning into this conversation with the management of Brigade Enterprises. Their operational performance, pre-sales up 27% QOQ or 48% YOY. You can pick and choose which metric you want to look at. Collections robust and sales volume at 1.5 million square feet, up about 29% and 39% again sequentially in YOY. You couldn't find too many faults with this. The notes that I read seem to suggest that leasing across the annuity portfolio also has been strong. So let's get in the management to talk about the continuation of the good times for them, because the previous 2 quarters as well that we've spoken to them, I think there have been some very strong numbers. But the questions would be around how would a slightly higher interest rate scenario augur for 2023 for most of their businesses. Ms. Pavitra Shankar, she's the MD of the company, joins us right now. Pavitra, great having you. Thanks for joining in. Hope all is well.
Hi, thanks Neeraj. Thanks for having me. Yes, all is good so far. As you've seen, our numbers are pretty good this quarter. Look forward to discussing it with you.
Yeah, so what stood out for you, Pavitra? Because there are a lot of line items which are looking strong. And was there something that you would have hoped turn out to be good, but didn't quite turn out as expected?
Yeah, I think the wins for us this quarter have been, I think the hospitality portfolio coming off of 2 years of a very difficult time. Now with the onset of domestic travel, international travel, we have a portfolio of 8 hotels, about 1,500 keys, and those are all doing very well. We are seeing ARRs and occupancy better than pre-COVID, substantially better than that, and we're actually looking forward to a very good Q4 as well. So I think while our hospitality portfolio is not a large part of our overall revenue, it is still great to see the comeback in this particular sector. Residential also has done very well. It's about 75% of our revenue, so kind of leads the business in as a sector. So there's been good demand from the residential sector. Customers are really looking for a good quality product from established developers, and the consolidation that we've seen in the industry has driven business towards larger players like us. So despite the interest rate hikes that you've seen, we so far have not experienced any reduction in demand or any sort of cooling off. That said, we'll still keep an eye on it, since now it's going to start hovering around 9% or more. But typically our customers take a 15 to 20-year tenure on their loans. So generally it doesn't impact too much. What we would have liked to see better or see improve is the leasing activity. While it has been good, pipeline is also good. But mostly we have vacancy in SEZ space. And as you know, the DESH bill has not really been passed or relooked at. So therefore, it is a little more challenging than maybe leasing up non-SEZ space. So that's where our team is totally focused on in terms of leasing up that vacancy. But all in all, a very good quarter, operationally speaking, and we're looking forward to the same for the rest of the financial year.
This SEZ leasing activity, irrespective of whatever teams and companies would do, would it be largely a factor of the change in regulation?
Yes, because the SEZ provision, there was a sunset clause for that in 2020. So therefore, any tenants sort of looking for those provisions don't get those benefits anymore. So while the vacancy that we have is primarily in SEZ space, while they are excellent projects, very well designed, already occupied and to a good extent, but the remaining that we have is in the SEZ space. So that said, we are focused on it, looking at ways in which we can incentivize non-SEZ clients to also take up that kind of space.
And how are those conversations shaping up? The point I'm trying to make is, I'll come to the other aspects in a bit, but this aspect, would it stay constant as it has been unless the regulation changes, or are you hopeful that the right amount of incentives might give you headways into getting the occupancies corrected?
Yeah, we're trying some strategies. We're not really pushing financial incentives, so to speak, because we believe that the space requires a certain kind of rental premium. They're all LEED certified buildings. They're brand new construction. They're developments with our partner GIC of Singapore. So, you know, in terms of how we want to actually position this product, we're not looking at financial incentives per se. They should be at top of market in terms of the kind of rents that they should be getting. But if there is something we can do in terms of the paperwork, more information on how to handle the regulatory aspects, that is where we're looking at helping clients. And I think that's kind of the support that they're looking for, because they do want their employees also are looking for this kind of well-designed spaces.
The annuity numbers have moved up a little bit. Now, my question is, what do you reckon is the way ahead, considering that there is a lot of belief that the near term, the next 3-4 years, India could be one of the key destinations for a lot of global firms to set up shop, manufacturing as well as office space. Do you believe that could turn the needle, or that's too small a number in the overall equation of the space available in such a large country?
No, I think there is always going to be a good demand for grade A space, whether it is in office or leasing, warehousing, and so on. I think in general, there will be a good demand for this kind of new grade A space from especially foreign or MNCs. So I think the outlook is positive in that sense. The government has also started to invest or continue to invest a lot in infrastructure, especially roads and so on. In the recent budget, they indicated that they'd be looking at 50 different cities and also in tier 2 cities, and also investing in those areas as well. So I think that augurs well for the overall economy. Some areas will do better than others. Metros like tier 1 cities will continue to do extremely well, but I think there's a lot of expectation for growth in tier 2 cities also. So depends on where the growth will actually happen, but I think in general, office should do well despite these questions about the hangover from work from home and hybrid and so on. We still think that there is a huge demand for good quality space where employees are actually looking for a certain level of well-being in their workspaces as well.
Is the demand supply still skewed? And just trying to wonder if that also plays a factor in how much offtake will happen, because there might not be enough supply, or that is now no longer again a question.
I mean, it goes market to market. I would say in Bangalore, the absorption has been very good. The supply it's not really in a state of oversupply. In fact, I think the last couple of years with an overall dampening effect on the leasing situation, the supply pipeline hasn't really been built, but a lot of us are looking at new projects, new lands, and so on. There are some markets that do have an oversupply situation. Hyderabad is one of them. So it really goes market to market, differs from space to space. But I think Bangalore, where we have a substantial presence in the office sector, and also in Chennai, where we have a growing presence in both residential and office, should do quite well.
Actually, so now I will flip it to residential and tell us a bit about the whole space. I mean, one is the supply demand equation there, two, the project launches, and I believe you launched one project in the quarter gone by, which could have accounted for pre-sales that you did, and three, the project pipeline for you in Bangalore and outside Bangalore.
Yeah. Yes, so overall residential has done well this year, and also that's continuing the trend that we've seen pretty much from the September after the major lockdown in 2020. Resi growth surprised all of us at that point, but it's remained consistent. So it wasn't just a question of pent-up demand at that standpoint. There are a lot of factors which I mentioned earlier. Consolidation overall, it was a good time, interest rates were good, but now we're seeing that the demand is continuing despite the increase in interest rates. So for us, what we've experienced is originally where the demand was mostly from completed inventory, we've seen it come back to under construction and now new launches as well. So at the beginning, basically in the past 9 months, we've launched around 2.5 million square feet in residential. We've been selling extremely well to the point where we have under 4 million basically of space to be sold. We're launching an additional between 2.5 to 2.8 million square feet this quarter itself. A lot of our launches did get pushed a little bit, but they're happening this quarter. The launch that you saw last quarter was a plotted development. It's a new domain for us. We were mostly in apartments, villas, and built space. So the plotted development project has done well for us. It launched last quarter, and we actually sold out last quarter as well. And we continue to see plotted launches this quarter, as well as in the mid-segment housing space, and one in the high end. So overall, we are seeing demand across the portfolio, which is a great thing.
Okay. And there is notes talking about, while you are present in Chennai as well, but there are notes talking about how, would it be Bangalore-centric for the foreseeable future, or could there be more broadening of this? What's your sense here on the resi side per se?
Yeah, so we've been communicating that while Bangalore is our mainstay, we are looking at Chennai and Hyderabad to expand our presence across these core markets. We're also in tier two markets like Mysore. We are in Kochi for hospitality and office. So we are examining other areas as well in the south where we can actually expand our presence. But we know that in order to scale, you do need to look at tier one markets. So Chennai is shaping up to be a very good second market to Bangalore. We have signed up new projects there. A lot of those will be coming in. We were hoping it would be in FY24 Q4, and we're pushing for that. But depending on approvals and so on, it could slip into the following financial year. But they're all in a stage of design and approval. So Chennai, we're very positive about. We actually saw very good uptake for our existing residential properties there post-COVID and during the last 2 years as well, whether it was high-end or mid-segment. So as a result, I think we'll be focusing a lot more on Chennai. Hyderabad is also a good market, but a little difficult to underwrite sometimes. It has unlimited FSI, so sometimes difficult to meet the expectations of landowners. But that said, we did extremely well with our Hyderabad project. We pretty much sold out in 18 months when we launched it in November 20. So we are positive about the South Indian markets, and that's where we'll be focusing.
Okay, sorry, I'm just trying to understand. You mentioned the new projects you were hoping to get signed in Q4 FY23, and they might get spill over to 24. Is that what you meant?
So we have signed the projects or in process of doing various stages of due diligence, and it happens parallelly with design and go-to-market as well. So we will be pushing to launch those in Q4 of FY24. Potentially could spill. Some of it could spill into FY.
Okay, thanks. Last couple of questions. First is on balance sheet and cash flows. So cash flows, I thought, stayed almost constant QOQ.
Yeah.
You reckon Q4 could be a slight deviation? And of course, the debt reduction that happened, you've reduced maybe 250 crores, or please correct my numbers, but a bit around here and there net debt. Would you look to bring it down even further in the quarters to come, or are you comfortable currently?
We've always been comfortable with our debt, actually. We've been paying down the residential debt. That's kind of where you see the maximum sort of movement on the residential debt front, because a lot of the residential projects have been self-funding, so to speak. We believe it's fine to use debt, because most of it is currently in LRD, lease rental discounting, and also in CapEx. So we're basically building out our office portfolio as well. We have another office development that we're currently working on in Bangalore. So the point of taking debt is to invest into our lease portfolio, whether we're creating assets or then taking out some of the invested funds in terms of an LRD. So I think the debt will continue to hover around there. It may not reduce substantially because we would generally look to keep building out our asset portfolio in terms of the leased assets. Yeah.
Got it. And cash flows, I believe, remain constant.
Yes, cash flows should continue in the same manner. Again, hospitality was one that has started to contribute substantially again to the cash flows. The lease portfolio as well, as some of the new leases start to generate the cash flow, we should see that increase. And our residential is consistent. It's basically linked to the construction progress. So we expect that to also increase as new launches start to come into the cash flow aspect.
Got it. Yeah, sorry, I didn't ask about hospitality because it's such a buoyant business across companies. Not one company is complaining about the kind of occupancies or ARRs. I mean, I'm at some point of time hoping the room rates come down a little bit because it's become tricky to afford them. But here's the question: do you reckon that both these factors continue, and are you expanding the keys at a fast clip because of the way the industry is currently, or how is it going there?
So, yes, I know anecdotally many people ask when the rates will come down, but honestly, owners, you have to make hay while the sun shines.
Yeah, most certainly.
It's been a tough couple of years, so we are actually quite happy when the ARRs go. In terms of expansion, we have one hotel where we had held off on the CapEx we had done the structure and basically have the fit outs to do. That's a small hotel in Mysore, but we are going to start reinvesting into that hotel now. We're looking at the sector. I think there are some good opportunities. That said, we will only take up hotels where we feel that the demand picture is correct or the location is underserved from a hospitality standpoint. So far, we've only done business hotels. We're examining whether we should explore into maybe a more leisure or resort kind of space. But we're also mindful that leisure and resort did very well only after the pandemic. Before that, it has been a very tough business. So we'll continue to be judicious about where we invest in the capex. It is a tough business, the hotel business. But that said, we have demonstrated the ability to construct at a very good cost per key and also tend to command a premium over the other hotels in our competitive set. So generally, I feel the hotel team is strong. We're able to show very good performance. And overall, the demand aspect over the next, at least the short to medium term, should be quite good. So we're very confident about this.
Great. My final question, and that's more about what could a slightly near term, I mean, what could Q4 show up, and not just in terms of operational performance, but the financial performance. And what would you have investors look at? Because frankly, when I look at your operational performance and versus financial performance, it's chalk and cheese even in Q3, right? So because there are some changes, right, recent in the last 4 or 5 quarters, which kind of confuse investors as well at times. So tell us about the near term, Q4, and financial performance, and how would you have investors look? So that's like 3 questions rolled into one.
You may have to remind me some of the questions.
I will.
Yeah. So in terms of the near term and Q4, on all fronts, we continue to see the same trends continuing. Residential, as I said, it's already mid of the quarter. We've already launched a substantial amount of the projects that we had in mind for this quarter, and we're seeing good demand on the ground. So I think the residential sales will be good. I'm not able to give guidance, but I think we'll be able to beat the numbers that we've been showing so far. On the office side, again, it will continue. We have about 1.5 million square feet demand in the pipeline. So we're hoping to convert that for the vacancy that we have. Retail has been doing very well. Consumption is good, around 30% over pre-COVID levels. And again, we discussed on hospitality. So overall, I think Q4 will be a good quarter for Brigade in operational terms. On the financial side, as you mentioned, yes, there have been a few exceptional items that have been there over the last 4 to 5 quarters, which may sort of be difficult to sort of really say what has been happening. But I think the main reason why there is a difference is because of the accounting standards that pertain to the residential sector. So that's kind of where, even if we're doing operationally very well in terms of pre-sales, we're unable to recognize the revenue until the units have been registered by customers. So in the coming few quarters, we actually have about 2 to 3 very large projects that are coming up for completion and handover. So we're hoping that will actually push the revenue numbers on that front. Because we basically incurred all the capex and the construction costs. We're just unable to recognize the revenue until the customers go forward and register those units. So that's what we'll be working on. That's kind of what the team is focused on. If we can do some of that registering this quarter itself, we should be able to see some improvement. Else, a lot of it will start coming in Q1, Q2, Q3, depending on, basically when we can get OCs, katas, and get customers to come to the sub-registrar and register. So I feel that, a lot of the scale up that we did in terms of operations, in terms of sales, that's actually going to start bearing fruit over the coming couple of years in terms of the revenue side as well for the real estate residential sector.
Okay, so financial performance kind of optically shows that improvement, which has not been showing thus far. But sorry, if I can just push in that one more follow-up there. I know we've kind of overshot the time, but just one final question. How are investors, global investors who talk to you for entering into a project or some other conversations, kind of look at or want to look at the valuations? Because like we're seeing, operationally you're doing well, financially you're not. At some point of time, financial performance will look very good, operational may or may not look as good. So, relative to the financial performance, if you indeed do the registrations, how would you have investors look at your company or the space at large? And how are global investors anyways generally looking at it?
Yeah, I think the way we've seen investors approach us is that they're very keen on having a good partner that they're going to see eye to eye with, and will be able to work on deals, not just one deal, but continuously work on something, because the amount of due diligence and the amount of investment, not just financially, that it takes into getting into some kind of investment structure with a local partner does take a long time. So I think global investors are keen to be invested in the real estate sector. Typically, you see it in the commercial sector. For residential, it is generally more high risk. A lot of them don't want to take development risk at all. So then it becomes a little difficult as to when they actually enter into the deal. So that is where we see more of the interest happening on the commercial side. For us, generally, we've been able to sort of look at the terms in which we want to engage with investors. We're looking at pure equity usually, so that we're aligned on the same side. And I think global investors will be looking at India to actually give them the kind of returns that they may not be able to get in their home countries over the next short to medium term, given the economic situation. So I think overall it is positive, but it really depends on a meeting of minds as to how you want the deals to be structured.
Got it. Well, may they meet more often for you and for your investors. Pavitra, lovely talking to you. Thank you for taking the time out and speaking to us. And all the best for the quarters ahead.
Thank you so much. Appreciate it.
The pleasure was ours. Viewers, thanks for tuning in.